in whatever way that you can, make your network aware of what you do and that you're great at it. And then when you get people interested in working with you, you got to go lights out customer service.
This podcast is for educational purposes only. Nothing you hear on this show is legal or investment advice, nor is it an offer to buy or sell securities. Always consult your own legal and financial professionals before making decisions. Welcome back to another Capital Flow podcast. I'm your host, Dallon Schultz. We've got an incredible guest on the show today. If you're looking to raise $100,000 or more for real estate investments, this is the podcast for you. And our guest today, Matt Faircloth, his book was Matt, I don't even think I told you this. Your book was one of the first books I ever read on capital raising about 5 or 6 years ago when I got started in the industry. So listen, if you've listened to our show before, you already know the caliber of the guests that we bring on. And I'm so grateful that Matt's taking time out of his day to be here. And one of the reasons I absolutely wanted to get Matt on is because of his passion for education in real estate. And it's not just capital raising. Capital raising is one aspect. And Matt, you and I were talking about this before we hit record, but your ability to just educate, inspire people in all aspects of real estate and to empower them to take action is contagious. And he's also one of the hosts of the Best Ever podcast. So he himself is constantly out there sharing information and just helping people really elevate in this space. But Matt, thank you for being here. Appreciate it.
It's an honor to be here, man. Thank you. I enjoy your energy as well. Looking forward to a cool conversation with you. I've enjoyed our chats at many conferences that we've crossed paths that as well. So yeah, looking forward to seeing you hopefully at Best Ever Con again coming up in a couple of weeks too.
Oh, absolutely. We'll be there. So, well, Matt, let's take a few minutes and just share with our listeners how you got to where you are today. Give them a little 3 to 5 minute just kind of backstory of who you are and how you got to where you are.
I've been doing this for a while, man. Hopefully I get it done in 3 to 4 minutes. I'll compress it real quick. I'd quit my job in 2005 to start investing real estate full time. Then I did that because before that in 2003, my girlfriend, now wife of 20 years, put Rich Dad Poor Dad in my hand in 2003. And that just opened up my eyes to the power of real estate investing. I was a traveling salesman at the time. Was moving out of one house. And so decided, I'm going to buy a house instead of renting another house. My lease was ending. So I'm going to go buy a house. So I bought a 3-bedroom, 2-bath with a couple of buddies moved in with me. And before you know it, oh my goodness, the rent these two guys are paying me is more than my mortgage. And so I'm making $60 a month and living here for free. So that was my first rental property, was one that I lived in. And before you knew it, Liz and I just were completely turned to real estate investing. We're like, holy crap, this is incredible. We need to do this full time. And so when we got married in 2005, I quit my job. And her and I, bumped into a lot of walls and had that lovely, little blip in the market in 2007 that we worked our way through and everything like that. But we slowly started to increase our deal flow and do more and more real estate opportunities, a lot of times with our own money, a lot of times with immediate family's money. But before you knew it, people were starting to show up and say, hey, how are you doing that? I want to do that too. I'd love to invest in real estate as well. I just don't have the time. And so finally, we started to put together small little syndications, like 50K, 100K, from a couple of friends of ours or friends of friends through SEC registered LLCs. And we would do small syndications. There's nothing that says you have to raise millions and millions of dollars to syndicate real estate. The SEC does not say that your minimum investment has to be $50,000. There's none of that. None of those rules are out there. People think that syndication means raising millions. It does not have to be. So we started doing deals with couple 100,000, 200,000, and then it grew to $500,000, and then we crossed over the million mark a few years later, and now we've built out our team, and I've still focused on raising capital. And we've scaled out to the point where our company's sitting on around 2,000 units of multifamily, a $10 million debt fund. We raised around $70 million in investor equity, and we did it one step at a time, one foot in front of the other, adding good team members over time. And I'm proud to say we're vertically integrated, so we've run everything from the property management company that manages the underlying assets, all the way to the loan placement company, all the way up to the individuals that find the deals and that run closings and raise capital for us. All of that's under one umbrella called the DeRosa Group.
That vertical integration is critical, and I know one of the things that you and I talked about, and what we're going to talk about on the show, is the future of capital raising, where capital raising is going. And so we're going to come back to that vertical integration, because as we operate a fund of fund, that's one of the main things we look for in groups. Are they vertically integrated? And so we could talk a little bit about that. I want to go back to a couple things that you mentioned. You got into house hacking before house hacking was even a term or a thing, or before Bigger Pockets or anything was out there.
I did all the things before Brandon Turner gave them cool names, right? Like, because I'm not a marketer like that, right? So I did a house hack before it was called house hack. I did the BRRRR strategy before it had a cool name like that, right? So I did all the things because it was just, back then it was just called real estate investing, you know? But now it's got all these cool acronyms and all that stuff. So yeah, that's what I did. I mean, it was a good deal, and I recommend a house hack to anyone looking to get into real estate that does not own their home, or maybe even if you do. A house hack is a phenomenal way for you to get your foot into the door of real estate investing, and because there's low money down options, it's a great way to alleviate your housing cost, if not, make a few bucks and live someplace for free. It's a great investment vehicle.
Ironically, that was our first dose in real estate ownership too. Our very first home we bought, the reason we settled on that home is because it had this unfinished apartment over a garage in the back behind the home. And so part of closing that home was having the contractor we were buying it from refinish that apartment. It made sense. It's like, hey, our mortgage is $970 a month. We can rent that for $600. Now we're only out of pocket a few $100. It just made perfect sense. And that was before I heard about Bigger Pockets and house hacking. It just, like, logically, it just made sense. So sure. I want to touch on that real quick, because for you, did you grow up in a real estate home, or was that something you just stumbled into? Like, what about that made sense to you and your wife? What made that click?
I had to de-educate myself in a lot of ways. And I love the family I grew up in, but I did not grow up in an entrepreneurial family. My father was the president. He was a draftsman for a steel firm, and he worked his way up to be the president of the steel company, and was given the option to buy the steel firm at one point from the owner, because the owner wanted out, and the owner was willing to sell or finance it for him, and the whole thing. And my father didn't want to take the risk. And so a ginormous company came in and bought it, and I mean, he was able to keep his job, and he retired through the company and all that, but like, that was not something that he viewed as an opportunity. He viewed that to be too risky for him to want to deal with, right? So I did not grow up around entrepreneurship. It's something I had to learn really by reading Rich Dad Poor Dad and by reprogramming a lot of my thought process. I was always told, when you're growing up, you're good at math and science, and said you should be an engineer. And so I did, because even though I didn't know what an engineer was or did, and so I went to college at Virginia Tech. You can see the logo behind me there. I went to Virginia Tech for college because that's where I was told that I should go because of what I was good at, and you should go get a job in engineering. And then I realized my senior year of college, like, oh wait, I got to tour a factory and I met engineers, and I'm like, oh, these are not my people. I'm a people person. I enjoy having a full conversation with someone, not just locked in a cubicle and crunching numbers all day, even though I'm good at it. That's not what I want to do, right? And so I got a traveling sales job that required an engineering degree. So I was able to luck out and get that. And I was able to travel, meet people, and those kinds of things. So that was probably my first taste of entrepreneurship, because like a commission-based salesperson they're an almost entrepreneur, right? Like, you're almost there, where you're meaning like, you kind of eat what you kill. You might get a good base salary, but you're not going to thrive unless you sell. So I did that for 7 years. I got really good at sales. And then I just took another step forward. And again, Liz put Rich Dad Poor Dad in my hand. And that taught me the difference between assets and trading hours for dollars and what I was doing in my job. And I saw how what my life would turn into if I stayed at that traveling sales rep job versus if I took a risk in my mid-20s and get involved in assets and in an asset growth and real estate ownership. And it made all the difference in the world by me leaning that direction. So that's, again, self-taught, and then started hanging out around entrepreneur people, business owner people, and everything like that. And that really was just by learning in my 30s how to think again and how to look at things in a different way as a real estate owner versus as a college trained employee, which is what I was up until that point.
I love you sharing your experience, and to our listeners, if this isn't the first episode you've been listening to, you'll recognize a common theme here. Almost all the guests never started in real estate. Yeah, and Rich Dad Poor Dad. Yeah. And that was me. That was my book. We read that book, and 2 weeks later, we bought our first fourplex without any of our own money. Like, something in my brain just clicked.
Some crazy. I could probably name off like two hands. I wouldn't be able to count them on two hands. All the syndicators and real estate investors I know, Dalton, that used to be engineers. I guess it's that analytical engineer brain. But so many real estate investors in our world, and mine and your world, I call them recovering engineers. And it's just funny that they realize there's more to life than engineering. And engineering is great. The world needs them, but for some reason, there seems to be that correlation between entrepreneurs, maybe just real estate or maybe all entrepreneurship in general and engineering.
I've noticed that as well. And I think part of it is, I know at least for me, part of the reason I like real estate is because I can see it. I can touch it. I can visit. It's very literal, and engineers are. Right? It's like the numbers, analytics, like the science behind it. And so I think it's just a natural path of progression, and they make killer real estate investors because they scrutinize the numbers, and a lot of them are very system and process oriented, as engineers need to be. You mentioned that you were in a sales position for about 7 years. I want to touch on that for a minute, because in the world of raising capital, it's 100% sales. And my mindset and belief system around sales has evolved over the years. And I came from the medical field where it wasn't a sales position. I was just taking care of people. And I know there's people listening to this that they have a bad idea. They have maybe a limiting belief around what sales is. So to that person, Matt, how could they work through sales and maybe some of those limiting beliefs around it?
I mean, okay, sales is tough, man. It's one of those jobs that you don't thrive unless you believe in yourself, right? There's a level of faith, and I mean, it could mean spiritual faith, or it could mean just believing that the goods that what I want to see is on the way, right? In whatever the word faith means to you, you got to have faith, because you could get into like real estate sales of like a realtor, where you're not making a base salary at all. You're not eating anything until you sell a home, and that's going to take you at least 60 days, if not 120 days when you first get in to sell a deal. And so and that means either people have to bankroll you, or you got to live in mama's basement, or you got to have a spouse that's willing to tolerate it, or whatever, or you got to moonlight, whatever it may be. You got to find a way to get in, and then there's a momentum that happens. And for most salespeople, that once you get that proof that, I can do this. This does work. I did sell. I did produce. I did get a check. It gets easier and the confidence comes up. But the first couple years of sales really stinks in some ways, because you end up, you're going to starve a little bit until it really thrives. I haven't met many realtors, like I just keep picking on them because they're in mine and your space of real estate. Most realtors don't do well their first year or two, but then something clicks, the momentum hits, and before you know it, they're making mid six figures and making it rain by closing multiple deals a month and everything like that. So I think that there's a certain mechanism in self-belief and also in networking. The salespeople have to network. They've got to get their word out there. I mean, obviously, social media has made it a lot easier. I'm old enough to remember a time before there was social media, and you had to just keep an actual Rolodex, and keep in touch with people, and take a lot of people out to coffee, and do a lot of asking for leads and everything like that, and all that. So in whatever way you make your network aware of doing what you do. And this really transitions to capital raising too, that my selling skills got, transitioned over to capital raising. In whatever way that you can, make your network aware of what you do and that you're great at it. And then when you get people interested in working with you, you got to go lights out customer service. It's one of those positions where a few different cylinders have to hit. Networking and customer service all have to be on point for you to be successful.
I love what you shared there, and I'm glad you brought this up about the awareness, getting in front of people, because when you started this back in 2003, 2005, social media wasn't a thing. And maybe it was just like starting to begin with, like, I remember MySpace that was out for a little bit. Like
I remember
Facebook.
I had a sister in college. at the time, and I set up a Facebook account in like 2009 or 10. And she messaged me, said, "What are you doing on Facebook, you weirdo?" I remember she's like,
"Yeah, it's for college. It's for the young college kids."
Right. It's just for kids. Why are you here? Go away. You're not cool. Right. And then that's how. Then Instagram comes out, so she jumps over to that, and then Snapchat comes out, so they jump over to that. Right. So,
do you know what they say about Facebookers now? It's for old people.
It is.
It's for old people.
It is.
It's funny.
Look at it. It's all a bunch of old people complaining about politics. That's all it is. That's all Facebook is now, man.
So where I wanted to go with this, Matt, all jokes aside, is before social media, because that can be a great tool. LinkedIn, Instagram, Facebook, 100%. To let people know what it is that you're up to. Your first few investors were friends and families. They saw, you said that they were watching, and they say, "Hey, Matt, we see what you're doing. Like, how'd you do it? We want to get involved." And that's really what opened up the doors for you to be able to start syndicating and working with other people's capital. Yeah. So what have you found to be some of the best ways to build awareness and let people know what it is that you're doing? And how has that transitioned over the last few years?
You got a little lucky. You got to get a little lucky sometimes too, Dalton. So I had dollars coming in from investors in like 2013, 14, somewhere in there, right? And so I started shooting YouTube videos to send videos to my investors. And I thought I'd send them some investor tips too. So I put them on YouTube, and I'll make them public. Who knows? Who wants to watch, right? And so I would send tours of properties we were buying, of rentals, and we always use them for marketing too, to say, "Hey, new investor, like new person that reaches out to me," because they're like no joke, like the brother-in-law of investor A told his brother-in-law about us, because that's how the word got out back then. And so I would just send the brother-in-law a YouTube video. Here's a tour we did of a property, educational tour of a property we're renting out. And before you know it, Dalton, I started getting comments on the YouTube video, people asking me questions. And I'm like, oh, that's not one of my investors asking me questions about this property. Let me answer their question. So before you know it, this YouTube channel we had started to take off, and it started to become a thing. And so I started answering more and more people's questions, and I would shoot this series called Mentorship Monday, where people would just email me questions and I'd answer them on the air. And before you know it, our email inbox was just blowing up for people emailing us questions. So the reason I got lucky is our company, DeRosa, got active on YouTube when YouTube was just becoming not a thing. I mean, YouTube's been around since the early 2000s, but more and more people were going to YouTube for educational purposes in the mid-teens, right? In like the 2014, 15, 16 range. And so we were probably one of the few people out there talking about real estate investing on YouTube at that time. And so we got a lot of attention, a lot of investors, because I was the guy online teaching about, hey, this is how real estate investing works. This is what you do. This is what you don't do. Because we realized that it was starting to make our phone ring. So I said, okay, I'll just go all in, and I'll just run around, like, no joke, man, run around with my cell phone and a selfie stick, just running around properties in Trenton, New Jersey that we owned, teaching stuff like, hey, this tenant just absolutely trashed our property when they moved out. Let's go turn the cameras on. And there's one where I went in before I even, I hadn't seen it yet. And I knew they had moved out. my maintenance tech had told me they absolutely wrecked the place. So I said, okay, let's go and show our audience. I'm not sure I'm going to be happy. I might not be happy with this, but let's go see what we got. And so it was just real. And that exposure of the reality of real estate investing in things like that, and just unfiltered, not selling anything. No, like run to the back of the room or, pay me 10 grand and I'll teach you the secrets of real estate investing. No courses, no nothing. Just, this is how this goes. It generated a lot of leads of real active investors, not students, investors, for people who want to invest with us because they saw our transparency. That was probably the breaking point for us. And then, we also were doing a lot of work for Bigger Pockets as they were coming up. And that was a breaking point for us, for my wife and I too. And that's a whole nother thing. But YouTube really was the way we leveraged social in the very beginning. We still do it. We still have a thriving YouTube channel with a lot more subscribers than I had back then. But that was how we got the word out back in the beginning.
Excellent. And if you haven't checked out Matt's YouTube channel, definitely go check it out. A lot of great content. And as you can tell just from this episode, he's an educator. He loves talking about his experience. He'll show you the good, the bad, the ugly. And you mentioned something in there, Matt, where you said investors, you weren't trying to sell them. You weren't saying, hey, run to the back of the room, but you were selling them in an indirect way by being transparent, and that ultimately led to trust. And if they being able to see you, hear your voice, and see how you went about deals, they gain that confidence to be willing to invest that type of capital with you. One of the things that a lot of people in our industry now struggle with is knowing what channel to focus on for raising capital. Back then, YouTube was the go-to for you. Now we got LinkedIn, Instagram, Facebook, YouTube, Google Ads. There's so many platforms or channels out there. Yeah. What advice could you share with somebody that might be trying to figure out where to focus their time?
Pick one, right? That's my advice. Pick a channel. I'll give you a few examples, right? And I'm friends with both these guys, so I'll just use them, but they don't mind if I pick on them. Brandon Turner, we might have heard of him, right? Brandon Turner got ginormous on Instagram, back in the day when he was running the Bigger Pockets podcast, because he was smart to mention his Instagram handle, and he put out really great, really interesting, a lot of times funny content on his IG page, Beardy Brandon, right? So he leaned into that. Now, Brandon's gotten big enough now where he's got other social brands, but he started with Instagram. That's it. Just Instagram post. That's it. And you rinse and repeat, do it over and over and over and over and over and over again, right? Andrew Cushman's a friend of mine. He does a ton of LinkedIn posts. That's all he does. Mostly LinkedIn. It's hard to find Cushman anywhere else besides, he's probably not on Facebook as much. His Facebook posts are of him skiing, but in real estate investing, all over LinkedIn. So you lean into that. And Andrew gets a lot of leads off of LinkedIn. Another friend of mine, Jay Scott, writes these long, article level posts about the economy. This is happening. Tariffs are doing this, and the economy's doing that, and jobs report came out, and this is what I think. So he writes paragraph long Facebook posts, right? Whatever it is you do, Jay's a phenomenal writer, right? So whatever your skill is, if you look back on it, Andrew's a good data guy, good analyst. That's why LinkedIn makes sense. Brandon's a phenomenal marketer. And so that's why, Instagram makes sense. And Jay's a great writer and a good, analyst of data and a good storyteller. So that's why Facebook made sense for them. So whatever capital raiser, talking to your listener now, whatever your skill is and ways that you're good at getting the word out, whatever media it is, be that if you're a good talker and chatter, open a podcast. If you're good on video and explaining things and you're okay with a little bit of video production, do YouTube. Whatever it is, just do it over and over and over again. I cannot tell you how many people I see, Dalton, that have big YouTube, big Instagram followings. They'll try and pull their traffic somewhere else, and it's a mistake. They'll be like, oh, hey, go to my YouTube channel to watch this video. Here's half the information. Now go to YouTube. No, man, lean all in to what you got, So I don't think people should try and move their traffic anywhere. Just go all in to one medium, and it doesn't matter what it is. There's people out there raising tons of money on TikTok. Whatever it is you got, And that's the bottom line. It doesn't matter. Just do it over and over and over and over and over and over and over again. And that's Gary Vaynerchuk 101. Pick a medium and just post the crap out of that one medium, and it'll work. And if you're making bad content, that's okay. Make more content, and then make content, and then make content, and then make content, and put it on that one medium. And eventually, something will bite and take off, and you'll get attention.
You'll figure it out. And that is such solid advice. I think too many of us, especially entrepreneurs, we all have squirrel syndrome. Let's be honest. We all look at the next shiny thing. It's a focus in the discipline. I opened up a profile on X and tried X for like a week.
So I'd done it too, Dalton. I'm like, oh, let's try X, or Twitter or whatever. Let's try this, let's try that. I had a marketing person for working with me for a while. They had me putting stuff on Pinterest, like, and that didn't work. Shocker, don't do that, guys. That's not going to work. I tried it. Don't do it.
Maybe, I don't know. Maybe if you were like an interior designer or something, maybe Pinterest would be a good channel. But awesome. Yeah, I think. I think if you're struggling with what channel to focus on, to Matt's point, pick one. Pick one that aligns with your personality and how you write things and do things. And it's funny that you brought up Jay Scott, because I was literally just talking about him this morning to my coworker. I was like, if you want to know about the economy and real estate, you go to Jay Scott. Like, that's just, know that. And he gets so much engagement on his post. And to your point, they're written posts. And so people that say like, hey, written posts don't get engagement, it's just because you don't know how to write, or you're not interesting enough, or you're not providing enough value, because Jay Scott gets tons of engagement.
I'll tell you a little secret, and this is for your listeners. They're like, well, I can't write. You know what Jay does? Jay doesn't write those posts. What he does is he goes on long walks by himself with his dog or whatever, to just get his brain clear. And he's got all the data in his head already. He already knows what he's going to talk about. And he gets out his cell phone and he does the text, words to text, and he starts talking. And he just talks it out. The economy really might be affected by the jobs report. And then he just talks and talks and talks. And then he uses, you can use Gemini, Google devices, whatever it is, to tighten it up. And then when he gets home, he then takes what he just said and writes it into a nice article. But it starts from his words. So, listener to the Capital Flow podcast, you can do that too, right? Whatever it is, do it while you're driving. Just like pull up your cell phone and pull up a Google sheet and then pull up the little text thing and start telling a story. Just start talking, and before you know it, it'll start to jive. You'll get good into the flow of it. It might not sound very good the first time, but you'll get the hang of it, and then you can go and transcribe it and turn that into a well-written article, of your words.
Hey, Dallon here. I have a special invitation for you right before we get back to the show. If you're out there raising capital or trying to, here's the truth. You don't need more calls. You need better ones. That's exactly why we host weekly Capital Flow workshops. Every single week, we bring in experts who show you how to generate more investor leads, accelerate trust in half the time, and pitch without pressure. It's not theory. It's what's working right now for active capital raisers in the trenches. No need to do this alone. Go ahead and click on the link in the description or the show notes below to make sure you don't miss the next workshop. Who knows what new idea or strategy could lead to your next investor. Join us live every week and plug into the flow. Click the link below to join us. And now let's get back to the show. And in my experience, if you don't strike while that inspiration comes, you lose it. You lose the words. You lose the way you wanted to express it, the expression with it, I guess. So excellent. Well, Matt, let's shift gears here a little bit, because before we started recording, we talked about how the focus of the podcast is obviously raising capital, but there's so much more to the capital game of real estate than just knowing how to sell and how to attract those 6-digit checks. And one of the things we were talking about was knowing how to place that capital, how to be a good steward of that capital. And you mentioned this earlier. It's not just about selling. It's like as soon as you sell, then you have that customer success experience that picks up right after it. So with your years of experience in real estate, what have been some of the best ways that you've been able to manage and really be a good steward of other people's capital?
Well, we've always, back in the day when Liz and I were raising money, in our early years of real estate investing, we were, one minute I'd be talking to an investor, the next minute I would put the phone down and then go and talk to a tenant or collect rent, go in the field and go look at a new property we were going to buy, or go do rent collections or go audit leases or whatever it was, right? So I was doing it all. And so we've always been vertically integrated, and I believe in that. I'm not saying there's anything wrong with just raising capital, but what I would say to someone whose primary function is raising capital, you've got to understand that raising the capital is half of the investor solution, right? The other half of it is making sure that capital goes to a good home and is well serviced, well maintained, and that it sees good returns on its investment, and that it comes back to that investor with hopefully a profit on top, right? The best way to do that, far and away, is being vertically integrated, as we are at DeRosa. Our company owns the property management company that runs the asset. We own the all the things in between the property management company to the dollars coming in the door. That is hands down the best way to ensure investor return on investment, investor safety in that. If you can't do that, or if you don't have the team to do that, or whatever it is, I get it. Not everybody can do it. So if you can't do that, what I suggest is you can't just go and raise capital and say, okay, let me go out and find the best IRR for this money for my investors, or God forbid, finding the syndicator that'll pay me the best fee for myself to put myself in front of my investors, right? So if you do that, it's going to be a short-lived career. But what you can do, what I would do if my hands were tied and I could not go vertically integrated, I would go out and find a capital S, small handful of operators that I like and trust, that I bring something to the table that they don't. Show me an operator that's great at operating things, but doesn't want to do the social media game, doesn't want to build up their list of contacts, doesn't want to raise capital. They just want to find the assets and make the assets run properly with a book of capital that you help them, that you provide to them. That is a great partnership. Maybe you could build a whole business around 2 to 3 operators, maybe not 30 of them, but 2 to 3 as a capital raising business. If you got a fund of funds, I'd rather, if I were to do that, I'd have a fund of funds that's funding like small handful. Don't even count them on one hand. Count them on 2 or 3 fingers of operators that you work with, that you like and trust, that are able to put the capital to work over and over and over again, that haven't grown too quickly, that aren't over their skis, that are just willing to grow pragmatically, and above all else, Dalton, they're willing to take your advice, and they see you as a team member, not just a resource of money. Just give me the money and go away. They see you as a team member, and they're going to allow you to kind of see the inside, see the inner workings, see, I want to see how the sausage is made. And then I want to be behind the scenes, see profit and loss statements, where are we at really? I would want to have that level of transparency with a small group of operators. If I was just raising capital, it can be done. It's done successfully by many, but you got to do it with caution and treat those dollars you give that operator even more importantly than you would treat your own money, because it's other people's money and you're not in 100% control of it because it's not your company. You're putting it into somebody else's machine. So just make sure that you see inside that machine too. That would be my advice.
Well said. And we operate a fund of funds, and there's only 4 people currently that we're partnering with, and 2 out of the 4 are vertically integrated. And so let's go back. Let's talk about that, because I think that's huge. And in fact, we had a guest on it was probably 2 or 3 guests ago. Their criteria, they invested a few million of their own before they started a fund, before they started investing or bringing other people's capital in. And he said what he's learned over this last year through 2024 is that he will not invest with any operator that's not vertically integrated. And so we talked a little bit about that. And since with you guys being vertically integrated, let's lean in on that a little bit more and help our listener understand why that is so critical, especially after this past year where loans were expiring, they were coming due. Let's talk a little bit about that.
Well, I mean, more and more people are going vertically integrated. I can't tell you how many people that have come to us to say, hey, how did you do it? Teach us, and that, which we have. We've consulted with a few companies that wanted to start their own PM companies. We've run consulting gigs showing them how to do it because we did it a couple of years ago. Here's our sheet of music. This is how we did it. The reason why vertical integration makes sense in that what is the mission of a property management company, right? The mission of a PM company, when you look at it, the profit center is to manage as much real estate effectively with as little people as possible. That's how they make the most money. Their bottom line is by putting their property managers on as many assets as possible to maximize their in-house take of the fee, right? Minimize risk, defer all risk over to the owners. So if there's a lawsuit, defer it to the owner. If there's a slip and fall, defer it to the owner. If the property doesn't do well, that's the owner's problem, not your problem. So that's why you never see a property management company that makes sliding scale or bonuses and stuff like that. Meaning the better my property does, the more money you make, property manager. No, they would never do that because that's them assuming some of the risk of real estate ownership. They don't want that. They're going to defer all the risk over to the owner. So if you look at that profit profile, along with one thing that's become more meaningful to us as a company, and that is culture, right? We don't have tenants. We don't use that word in my company. It's just part of our culture. We have residents. And that sounds like a small thing, but that means that the residents we have, I want them to treat and feel like where they live is their home. It's not a place they stay. It's not some place where they're just hanging their hat for right now. It is their home. And so that's why we don't have apartment buildings. We have communities, right? And so there's a certain language that we have at DeRosa, and it was very hard to do to get our property managers to speak that language too, because they're not my staff. They are not my employees. They work for a property management company, and some of them may be working for my building one day and somebody else's building another day. And they're not going to speak my language because they're speaking the language of the PM company, and they're on the mission of the PM company, which is to make the PM company money. Right, to keep the PM company at a risk, right, and to make profit for the property management company. And if the owner makes money too, that's good, because that means the property management company is not going to get fired, right? That's why they want the owner to make money, is so that they don't fire them. That's it.
It's almost like they do just enough, though. It's almost like they do just enough,
bare minimum.
So they can show that, hey, we're managing the property, but it can be operated so much more effectively and efficiently.
Yeah. I used to own my own PM company when I was a small landlord in Trenton. My wife and I built up our Trenton portfolio to 115 units at one point. And we owned the PM company ourselves too. And I gave us like an 8 or a 9 out of 10 because we did great, because I was in the middle of it. It was tough to grow and scale, Dalton, because it was just me sitting at the top of the food chain. And my primary function of the company needed to be raising capital. And so we outsourced PM to a third party, and I rated them at a 6 out of 10. And I needed to tolerate that so I could raise money, so I could scale, so I could build our business beyond, which was okay at that point. And then they went from that company went from a 6 to a 3 out of 10, and we had to fire them. But now we've grown and scaled. We fired them then, and then we just picked up PM when we got around 2,000 units of multifamily, and that's been a whole nother ballgame. And what your listeners need to understand is there's either a small PM company that just takes a larger fee that's a percentage of rents, or there's very big PM companies that have on-site staff that run multifamily assets, and they take a way smaller fee, but the on-site staff, their full-time payroll job is to run the apartment building that they are managing. That's their full-time position, and there's a lot of power and strength in that. You can convey so much culture and passion to those employees by helping them understand, hey, these are your people. These residents around you, these are your people. Your job is to make them feel and treat it like home, and pay the rent too, right? But also feel like home. And so they want to open up a community garden, great. You want to bring a barbecue in and cook hot dogs for them and give balloons to the kids on the weekend, do that, great. I want them to feel like it's home, and have pizza parties and stuff like that. And we have a few properties that have community rooms. Your tenants want to use it for a birthday party for their kid, do it. And so we allow we've built out a company that allows those kinds of things because I control it. And I can convey that culture to the staff, which you can't do if you don't own the PM company.
And what I think a lot of people don't realize, I didn't know this when I was getting started, when you get into larger real estate assets and you have large property management firms, those on-site people, the management company's not paying them. They're on your payroll. You're the one actually paying their salaries. The property management company is managing them, right? And finding them. But at the end of the day, it's your property that's paying them. So you're paying them anyway.
And I talked to them that's probably when the light bulb went off, Dalton, is that we had like a 200 unit in North Carolina, and me and my partner were talking to the site manager. That's like this, they're like the head of the food chain at the local site. Typically a bigger apartment building like that will have a site manager and a leasing agent, and then probably 2 maintenance technicians, right? So we were talking to those people more frequently than their boss was. Their boss was a regional manager that came to that site once a month. Right? That's how frequently they came to the site, because the PM company had stretched that regional manager out over 3 states. So that's all the only time they could afford to get over there was once a month. We were talking to them every week, sometimes twice, sometimes 2-3 times a week, right? Maintenance tech would just call me on my cell phone direct. So we had that epiphany. We're like, what are we paying them this 3-4% for? You know? Because these people work for us. I see their payroll on my profit and loss statement. I'm paying them. I know exactly how much they make. See, here it is. And the PM company was very good about pushing all expenses over to us. So all the software we used on site, I saw like reams of paper because the site manager needed paper from Staples or whatever. So that would be on my profit and loss. I'm paying for that. PM company wasn't even giving me paper at 4%.
You're paying for everything anyways.
Yeah. And I was doing the management anyway, so I'm like, I feel like I'm taking crazy pills, paying this 4%.
Yeah.
Why don't I just do this myself? So that's when we started to architect out what we needed to do to manage in-house. You can't. It's hard to do on just one property, but if you have a couple of them, you have enough economy of scale that you can start to manage in-house on a couple of multifamilies.
So if there's someone listening that's in that position, they own a few, maybe it's a third party management in place, they're thinking about making that transition, what would be a next step for them? What could you share with them, given your experience of what that next step looks like?
Well, I'll piss them off real easy. Pull out a calculator and do the math on how much in PM fees you're paying right now. And that you may look at that and say, geez, I could pay a full-time staff person if you're paying like 8-9% on scattered site. Like if you got a bunch of, 5 units, 10 units, single family homes, whatever you got, doesn't matter. If you've got a reasonable portfolio, make yourself mad. Do the math on how much you're getting charged in PM fees and realize you could keep charging that PM fee and that could be your money, right? And you could do that work yourself. If you have a full-time job doing something else, maybe you could become the property manager and you take that 8% PM fee, or you could hire somebody to do it for you that you can control and drive culture on. And if you have a larger portfolio that involves multifamily, do the math, add up that PM fee. That'll make you real mad on how much they're taking in PM fees, and realize that just with a small insurance policy, you could do this yourself. You really could. So that's what I would advise. And get consulting. It doesn't be with us. We do offer that kind of service for people that want to start their own PM companies, but get someone who's done it to teach you. Because depending on the state you're in, you may require a broker in charge or a BIC to be involved in what you're doing. There's certain insurances you need, but these mountains can easily be climbed with the right person showing you, and I can promise you it will be way better run under your leadership versus whoever's running it for you.
No one's going to care about the deal and the property as much as you do as the owner. Yep. And as you can control it, as you invite those people into your business to participate in your culture. I love that you brought that up, culture. You have more control, and you can find that alignment with people. And if they don't align with your culture, you don't work with them. If it's a property management company, you can have a conversation with the regional and maybe move some people out, but then they're slower to act and they got to find somebody. Yeah. It draws things out. And I'll give you other ways you can make more money with it too, Dalton, in that like we have a few multifamilies that are like near each other geographically, because we believe in geographic density, like going all in on certain geographies, right? Yeah. So if someone listening owns one apartment building in a town, they happen to buy another apartment building in that town or within like a quick drive from the other apartment building that they own, you could share staff. This happens. We do this all the time. Where like
we have a lot of vacancies come up at one of our properties. I will send maintenance techs from a property that's a little light on work orders. I'll send techs from that property to help turn units at the other property, and I can do that because I own the whole thing. You can't do that if you're using a third-party PM company. They'll do it for you, but for a fee, and they'll scratch their heads and, well, I'm sure we can do that, or what about this, what about that? They're not going to be Johnny on the spot and do that. We even, in our portfolio in Lexington, Kentucky, we have one maintenance tech that doesn't work at a complex. He just floats. He's just our one floater guy that just pops around from property to property, and he's HVAC and refrigerant certified. So he's our one dude that can repair HVAC machines and stuff like that. So you end up, you can add in talent and creativity in the labor pool like that if you own the PM company. There's our prior PM company, there's no way they would have thought to or would have been willing to do something to go take on a higher payroll like that and hope that guy stays busy. We figured it out because we own it.
Yeah, makes sense. Well, we didn't even get into conversation about how AI is going to play a role in capital raising and property management. But with the last couple minutes that we have left here, Matt, let's touch on that. And it might warrant another conversation. So you're vertically integrated, heavy in the management. You're also raising capital. There's been so much advancements with just technology and softwares and AI. How is the DeRosa Group prepping to integrate this into what you guys are doing?
We're all over AI. We use it quite a bit on our marketing side, not to write anything for us, but to proofread or to add value. Like I'll write an email to investors, like an investor update. We'll write the whole thing out, put the bullet points in there, and I'll ask AI to polish it up for us. We use Gemini, and Gemini has a polish button. It just goes in and polishes. We're developing an AI bot for our website, and we're teaching the AI, we're training it all about our company, because you can do that now. You have to talk to it, you have to work with it, you have to literally I'm having conversations with the AI, teaching it about what we stand for, what we do, having it read through our offering memorandums, and having it watch our YouTube videos. Believe it or not, you can do that with some of them. ChatGPT can't do that, but other AIs can watch videos for you and then learn from the video. So we're training an AI bot that when we feel like it's ready, it will be there on our website, and it will know our investment vehicles. It will know what we can and can't do. It'll know our rates of return historically, and it will have goals. That when people start interacting with it, its goal is to, through conversation and take its time, to invite you to book a call, right?
Yeah. And
it's to invite you to let me answer your questions, and then once you get your questions answered, have I answered your questions? Would you like to talk to one of our sales reps to take the next step? So I can have AI take people from curiosity to like a conversion, to a yes. Because that's the sales 101 is going from awareness to curiosity to close, right? They might not even be aware of you. They do that through social media, Google, that kind of thing. But the curiosity piece is one that you and I as capital raisers have to educate people about how great we are and why we're different and that whole thing. But if AI can pick up that middle section of someone who's curious, but getting, you know what, I would like to hear more. I do want to talk to a person, or I'd like to review some of your offerings. AI can do it with the right training. So that's one angle that we're using AI on. I'll touch on one more piece about the future, and that's blockchain. It's on its way. There are companies that are trying this. Nobody's doing it really well yet, but there is an opportunity, I think, in the world for, let's say you raise in one of your fund of funds, $100K from somebody that puts it into a deal, and you've got a 5-year lock because they're in a multifamily deal, or it's diversified into a couple of different things, however it's set up, right? At some point, that person may either have a life event that they need to get that capital back, or they decide they just want liquidity. Up until now, we as syndicators are not able to provide that liquidity unless you've got a super fancy fund that has liquidity built in, which makes it very complex, and that's tough to be able to do all the time. But what if somebody shows up and says, I want to be in that fund, and you can sell the seat of investor A to investor B, maybe not the whole seat, but maybe a small fractionalized portion of it. You can do that with blockchain. There's blockchain tech that can come in that can make an anonymous transaction that I can put my shares up and nobody even needs to know who I am. So I can do anonymous sales of fractionalized portions of my portfolio in Dalton's investment fund, right? It's almost there, and so there are companies that are selling secondary equity now, but it's not done enough. And I'll give you one more. What if there was a platform that was using blockchain tech that they could trade, as they would on the stock exchange, some of Matt Faircloth's equity in one of my funds, and they could sell out and buy some of Dalton's equity in one of his funds, or somebody else's funds, Joe Fairless's funds down the line, or something like that. So that's on the way. We're not there yet, but it's on the way. And I believe through tech like blockchain and maybe some AI in there too, we'll be able to evaluate, and real estate syndications like this, passive equity, becomes something that gets bought and sold more frequently than it is now, through selling micro shares of it.
And I think it's going to become more obtainable for people. You and I'm not sure what types of funds you structure. We're structured under a Reg D 506C. So we're limited to accredited investors. But there's already changes happening that will enable you to allow non-accredited investors in, whether that's through an exemption or a test that they can take. So there's all these changes happening. And then with this blockchain technology, it's going to make it more so of a marketplace and really open up the doors to more people to participate in deals like this. Right now, for the last, I'd say 10 years or so, you and I have been educating people that you can even own apartments. Most people don't even know that you can own some fractional ownership in apartments. And I feel like it's at a point where it's becoming more and more knowledgeable, or accessible, especially through content and stuff that people are putting out. So I love those thoughts. I love those thoughts and ideas.
I love it. I'll give you my dream is that, what if like a tenant in a multifamily complex that you own a piece of, right? Their rent's $800 a month, $900 a month, right? Typical, middle income rents, somewhere maybe even $1,000 a month, right? What if they write a check for $1,000 a month for the living expenses for their rent, and they pay another $300 a month, and that $300 buys them equity of your fund that owns that apartment complex, right? They could put their kids through college. They could do what you and I do through our mortgage payment. My mortgage payment that I pay is slowly buying the asset that I live in, right? Why can't tenants do that too? Through blockchain tech, through changing the way that the SEC views accredited, not accredited rules, and through allowing that what you and I do to be offered to more and more people, that there's no, again, I said in this at the beginning of the interview, there's no reason why $50K needs to be the minimum investment on anything. Yep. Your minimum investment could be $100, could be $1, doesn't matter, right? And if they make the paperwork easier, or if tech helps us with the paperwork, right? Then there's no reason why I can't invest in your fund for $1. Right? Yeah. You might not want to do that now because of all the paperwork you got to do. But what if the paperwork didn't exist? Yeah.
It's only a matter of time.
Yeah. I think that's the world we're going to. That's the world I look forward to, because that tenant could put their kid through college, could do a savings, but they never have to move. As long as they don't outgrow the apartment, they never have to move. They could live there, and if it's a good community and a place that they can call home and those kinds of things, they're living there as a legacy, and they're happy with it, because they might, before you know it, they might have 20, 30, 40, 50K in equity that's paying them dividends, for where they live. Think about that,
And we see this in businesses. There's employee-owned businesses. They're not publicly traded. There's all the employee stock. Like, who's to say? And an apartment business or apartment building is a business. Why can't it be a tenant-owned business or a renter-owned business? Like, who's to say what the limits are there?
It could be investors too, or you could have an investor that puts in $50K, and instead of getting a one lump sum buyout through blockchain tech, they could slowly get nibbled away at their equity, and have their equity get bought away from them at a profit. Their equity gets bought away from them either by tenants or by new people coming into the space or whatever it may be, and that they just slowly get bought out over time and make a return on their money of selling their principal back to the company and their returns too. So a lot of it's an exciting time. I'd like for a lot of it to move a little quicker than it is, but I think we'll get there. And I think it's through podcasts like yours that the word gets out for people hearing about new ideas, new concepts, and everything like that. So I kudos to you for having this show, and having me on it.
I appreciate it. It's been an absolute pleasure. To our listener, again, as you could tell, every single guest, extremely high caliber that we have on the show. If you're looking to raise $100,000 or more from a single investor, this is the show for you. The strategy, the ideas, the things that we discuss and talk about, it's just here to set you up for success. Matt, thank you so much for your time. Taking time out of your day to spend it with us. And it would be a blast to have you on a year from now and compare it to this conversation and dive more into depth of the tech, because it's gonna be taken off. 2025 is gonna be a wild year for AI and tech.
I love it. And forward and all of it. It's just, the whole thing's going to start moving fast. So thank you for having me. If people want to hear more about me, they just go to DeRosaGroup.com, DEROSA, DeRosaGroup.com. All the things that we do are right there at that website.
And again, I'm going to point you to Matt's education. He's on YouTube all over the place. They offer courses for people if you're looking to get started. If you're in one of those unique positions where you're considering vertically integrating, reach out to Matt. He's there to help you out. Until then, we'll catch you on the next episode.